in 2007, May. I was a young lawyer working in the counsel's office in the governor's office, writing an executive order that was going to create, in fact, did create, the Blue Ribbon Commission for modernizing financial regulation, which the members of which included Lloyd Blankfein, Chuck Prince, Bob Hendrickson, and Martin Sullivan of AIG. So this was 3 months before the onset of the financial crisis, and that's what people were talking about. This was May of 2007. In August of 2007, you saw problems in the asset-backed commercial paper market, and yet the world was talking about international competitiveness, the same arguments that Sheila was talking about just now. So in some ways, the world is exactly the same as it was in the eve of the financial crisis. They're making the same arguments back then, and that commission just, out of sheer embarrassment, just never came into being, and everybody pretended like it just never happened. So, leave the room and don't talk about it. That's kind of what happened in those days. But I thought I'd give an overview of what the deregulatory frontiers actually look like and what the specifics are in terms of what's happening. So the starting point for me is the executive order that President Trump issued in February of 2017, which directed the Treasury Department to do a review of all existing laws, rules, regulations, statutes in financial services to identify those that were inconsistent with certain core principles that the president articulated in his executive order. That led to a full-blown Treasury review, and the Treasury Department released 5 reports. The first one on banking, the second one on the capital markets, third on asset management and insurance. The fourth was on the FSOC, and the fifth was a sort of a related, not really coming out of the executive order, but a memo that was issued alongside, and that was the Orderly Liquidation Authority, and that's something that Sheila referred to in her talk as well. Collectively, these 5 reports are hundreds of pages long. Each report, for the most part, is at least 100 pages. Some are more than 200 pages. Some are slightly less than 100 pages. But collectively, they make close to 1,000 recommendations in every aspect of finance and financial regulation. Simultaneously, there was an effort in Congress that predates the executive order. And that was led by Senator Crapo, that culminated in the passage of what's called, it's a very long title, it's the Economic Growth, Regulatory Relief, and Consumer Protection Act. Yeah, no, that's right. They should have attached that, put that in the name as well, but there wasn't enough room. And that legislation was intended to primarily benefit small banks, but like everything else in Washington, it came with certain sweeteners for the large institutions as well. And then the third prong of the deregulatory universe is the administrative process through which regulators propose rules, and there you've got a recent proposal on the supplementary leverage ratio, basically pegging it to what's called the GSIB surcharge. Without getting too technical, it's a surcharge that the calculation gets pegged to, and some changes to stress testing assumptions, and also a rule to make some changes to the Volcker rule as well, which is a ban on proprietary trading by banking institutions. So that is the universe that I'm thinking of. There are other things as well. There are rules the SEC and the CFTC are working on, but primarily that's kind of the universe of deregulation that's out there. My overarching view of this is that while there are some good things in this deregulatory effort, on the whole, I think it's a net negative. And the reason I say that is because it runs afoul of some core principles. Number one, it's grounded in the unsubstantiated claim that somehow the post-crisis regulatory regime is a drag on the economy or has reduced market liquidity. And these are very convenient talking points for lobbyists, but Unfortunately, the facts just don't bear them out. The data just aren't there to substantiate it. It's very convenient as a talking point in Washington to get people to act, to say, oh, a la May 2007 when I was writing the executive order. It's sort of the same disingenuous argument. Number two, it runs afoul of the basic notion that we should keep the historical context in mind. The seeds of banking crises are sown when things are good, times are good. I think we're seeing the same dynamic now. We're in a good phase. People are making money. There are certainly some storm clouds ahead. Some people are choosing to ignore those storm clouds. But now is the time to implement counter-cyclical policies as opposed to, pro-cyclical policies. And we've done this over and over again, and it's perhaps it's human nature, or perhaps it's just sort of, ignorance of the past. But we succumb to the same temptation to reduce the requirements, and then after the fact, we always tighten regulation as if this time we're going to get it right. But then the cycle continues; it perpetuates, and on and on and on. And I think policymakers should be looking inward to see, are we at that moment again, and are we acting the way we should be? And then finally, I think the third core principle is that you need to recognize that a resilient financial system is absolutely critical for sustainable economic growth. You can certainly make politically expedient short-term decisions, and it might get you some accolades. But if your goal truly is economic growth, then I think resilience should really be at the fore of your thinking. And unfortunately, that's not the case. And so we see that in the Economic Growth Act. With the custodial banks, as Sheila talked about, having the ability to take out their central bank reserves from the denominator of their supplementary leverage ratio. When you take things out of the denominator, the effect is that it goes up, the overall fraction. You're seeing that in the rule on the enhanced supplementary leverage ratio that the Federal Reserve and the OCC put out. That the FDIC did not join in, and I think that was the right move. And you're also seeing that on the Volcker rule, where some very important protections that were put in place to make sure that certain exemptions under the Volcker rule are not evaded. That also is being eroded. So we see that. Layered on top of that is the fact that we have a regulatory structure in this country, and others have alluded to this, that is extremely fragmented and antiquated. It's a regulatory structure that no one person at one or a group of people at one time put together. It sort of accreted over time. It's the result of political quid pro quos over generations, and the people who put it together didn't know what the financial system was gonna look like when all of it was put together. It's extremely fragmented. And so we said in Dodd-Frank, let's get everybody in a room together, and we established the FSOC. And I think that was very important to do. But the FSOC does bring the underlying dysfunction of the regulatory system into the FSOC. And that's problematic. And it's also a little problematic that if you look at the Treasury report on the FSOC, and there's this talk now about activities-based regulation, which means different things to different people. To me, when I think about activities-based regulation, and this is, maybe it's too good of an example, but if one were to say, okay, the repo market was at the center of instability during the financial crisis, can we designate repo as an activity? That's problematic. And I was hoping to see something like that in the Treasury report, but there was nothing like that. Under the Treasury report in November 2017, they articulate a three-step plan. The first step is the FSOC will get together and try to figure out if there's a problem, if there's an activity or a product or an instrument that is problematic. If they decide it is problematic, then they're going to go to the functional regulator to beg that functional regulator to do something about it. Chances are they're not going to do anything. Then they're going to write them a letter. They're going to say, we recommend under Title I of Dodd-Frank that you do something about this. And if that doesn't happen, then the third step is we're going to designate individual institutions. Well, how is that activities-based regulation? It's not, in my mind, certainly. But there's some indication that we're going to see some more activity on this front, and so we're going to look forward to seeing that. A related point is the Office of Financial Research, which deals with data. And it's very important. One of the most important points of the financial crisis was we didn't really have data. We didn't know what was going on. And so we established the OFR. But the OFR is now under attack. It's not like the CFPB. There's no political constituency. There's nobody protecting it. It just sort of sits there as an orphan. But it plays a very important role. And the person heading it up now is a dual-hatted employee of the Treasury Department. The person who's been nominated is someone who's been hostile to the agency in the past, and I think that is problematic. So with that, I'll stop.